Welcome to Asian Quick Take. I am Jacob. The Federal Reserve announced its decision to raise interest rates by 50 basis points on December 15th, as expected. In its statement, the Fed expects to raise rates by at least another 75 basis points to 5.1% by the end of 2023, before slipping to 4.1% in 2024. At the same time, the U.S. economic growth will be in a state of near stagnation. Federal Reserve Chairman Jerome Powell said after the statement, "It is too early to talk about rate cuts. The focus now is to ensure that the Fed's restrictive policy stance can be enough to bring inflation down to 2% target." This led Wall Street to worry about the Fed's hawk-endless expectations will again smash the financial markets. This also signals that the interest cost of debt paid on U.S. Treasuries will become higher and higher, and the cost of financing the dollar will become more expensive for the Vietnamese economic market. At this point, the Federal Reserve will covertly transfer the risk of high inflation and debt costs, which will accelerate the process of harvesting the black hole of the Vietnamese economy and financial debt market. And the plunge in Vietnam's financial markets over the past few months means that the harvesting effect of this round of strong dollar on Vietnam's markets is ramping up. This could reach a new financial shock for Vietnam, involving a broad repricing of bonds, stocks, and other financial instruments. In recent years, Vietnam's economy seems to have suddenly turned into an Asian economic black hole, sparing no effort to absorb capital, debt, technology, manufacturing companies, and even talent and other related resources from the U.S. But in the vicissitudes of the global economy, the predator at the top acquires the wealth of other countries, and the U.S. is such a modern financial pirate. This in Vietnam's central bank in response to the Fed's continued aggressive rate hikes. Since September this year has been the second consecutive emergency refinancing rate increased by 200 basis points to 6% in order to control the country's rising inflation and financial turmoil. This indicates that Vietnam's debt repayment costs and stock, debt, and exchange market risks began to multiply. It is likely to be this modern financial pirates to increase the size of the harvest wealth. Vietnam's economic miracle may be the United States back to the original shape. According to the latest data released by Vietnam's Statistics Department as of December 10th, the total debt in Vietnam's banking system increased by 11.46% compared to the end of 2021, and credit growth will reach 18.16%, an increase of 3.14% compared to October. As of November this year, the total amount of all external debt of Vietnam is about $189.3 billion US, and the total amount of external debt, mainly in US dollars, is 181% of the proportion of this international reserve assets, and the proportion of this external debt of the Vietnamese treasury is 46% and continues to expand. But according to data released by Vietnam's central bank, it seems that Vietnam no longer has enough foreign reserves to defend the Vietnamese dong, and since October 1st, Vietnam has sold off at least $55 billion in foreign reserves, which makes the size of its foreign reserves may fall to less than 100 billion or so. The core crux of why Vietnam's finances are vulnerable is that it is caught in a dollar debt trap and wants to use it to do a swap of interests with Wall Street groups. Vietnam's high economic growth in the past, an economic miracle that relied on the accumulation of risky loans and foreign debt to expand growth, was all piled up on huge amounts of dollar-denominated debt. Since 2022 to date, Vietnam's VN30 index has plunged 30%. It has been led down by banking and real estate stocks, relegating it to the worst-performing stock market in the world. This is in stark contrast to 2021, which attracted a large amount of U.S. capital to drive Vietnam's stock index to record highs. Since the Federal Reserve began raising interest rates in March this year, some sniffy international funds have withdrawn from Vietnam's financial markets ahead of schedule. To date, foreign investors have sold off a whopping VND 1,460 trillion of Vietnamese financial assets, almost 5.62 times more than the same period in 2021. Currently, High inflation in the European and American markets is affecting Vietnam's domestic production activities and pushing up Vietnamese inflation. This will be a major challenge for Vietnam's economy and financial markets. Meanwhile, the recent aggressive monetary tightening moves by the Vietnamese authorities have increased refinancing risks and threatened the debt and credit markets. Vietnam's economy experiences an economic crisis almost every 10 years. Although, since 2010, Vietnam has achieved an enviable economic growth trajectory. However, Vietnam has been unable to cope with the soaring cost of borrowing in US dollars and is likely to fall victim to longer and higher interest rate hikes by the Federal Reserve, making Vietnam's economic model less sustainable. Vietnam's economy only pursues the quantity of investment without paying attention to the efficiency and quality of investment, leading the country to fall into the dollar debt trap. Vietnam's economy is supported by low-end manufacturing industries with little added value, and most of the profits in factories are held by European and American capital, which inevitably becomes a sacrifice.